Just to let you know, we're going to get started right around 4:05. All right, I'm going to go ahead and get started. Thank you, everybody, for attending. We are recording this one. So if there's something that we say that you want to hear again, let us know. For those who don't know, I'm Spencer Betts. This is Andrew Betts. We're the principals here at Pickling Financial. What we started to look at is there was a bunch of changes coming with the changing of the year in 2023, and we're saying, no, there could be some good opportunity to do some education for our employees. And then on December about 23rd, the federal government decided to put a bunch more changes in. So we wanted to use this opportunity to kind of explain where we think some unique opportunities will be going forward. Hopefully these will be more actionable for you if you're involved with it. Hopefully we'll give you some ideas on how to take action. We're not going to really focus much on the stock market, so we're not going to give any sort of update there. This is really more on a lot of tax law changes and other areas where we think people should take advantage of some new rules that have been coming through or that are starting now that we're in 2023. So that's really going to be the focus. And so what we're going to do, we're going to go through some prepared remarks. If you have a question, I feel it's a little bit better if you try and put it into the chat. It's a little easier for the presenter to read those questions and then answer them. So if you have a question, if you go into the chat feature and write them down, or at the end of the presentation, we'll pause and then people can unmute themselves and ask any questions. So with that, we're going to go ahead and get started. Audrey is going to be kind of in control and she'll move the slides forward. So we're going to start out with Bruce Goodman. So go ahead, Bruce.
So I'm Bruce Goodman. I work from the Linfield office, and I'm going to talk just a little bit about some of the changes relative to the amount of money that can be put into the plan 401k plans and profit sharing plans. This year was the first time that in a long time that both the employee deferrals and the catch-up contributions went up. In past years, very seldom did they both go up together. In 2022, you could have everyone could have deferred $20,500. That's been increased to $22,500. The catch-up contribution had been $6,500. It's now $7,500, which means that anyone can put in up to $30,000, deferral of up to $30,000. In addition, if there's a profit sharing element, a combination of the 401k deferral, which is the employee portion, and the employer portion has been increased from $61,000 last year to $66,000 in 2023. And even though we're going to talk only about 2023, I should point out that in 2024, all catch-up contributions for employees who earn more than $145,000 a year going to have to go into a Roth bucket, which means there's no current income tax deduction. In the long run, it's probably better to use the Roth, but you should know if you're earning $145,000 that you're going to just be subject to the maximum. And if it's not increased next year, it would be 22.5.
Thank you, Bruce.
So my name is Audrey Cohane. For those who don't know, I'm an associate advisor based out of the Lexington office. I hold a National Social Security Advisor certificate. So if you have any questions about Social Security at any point, feel free to contact me. My email is on this slide. There's not too many changes coming in 2023 in terms of Social Security. One thing to note is that there was an 8.7% COLA adjustment, which is quite large compared to the previous years. And this is even if you're not currently collecting, that will be added to your monthly income if you are over 62. 2023 is the last year that you have the possibility of using the restricted application. Very few people still have this ability. It's only if you were born before 1954. So in 2023, the last people who have the ability to use this are people that were born in 1953. Basically, if your spouse is collecting, you have the ability to collect spousal monthly benefits until you turn 70, and then you can change to start collecting your own benefits. And your benefits will continue to grow while you're collecting off of your spouse's Social Security. Again, very unlikely that this applies to you, but if somehow it does, you can talk to me and we can figure out how we can get you the maximized benefits. And then finally, the Social Security tax is going to be on income up to 160,000. Last year it was about 142,000. So you will see a higher tax being taken out of your yearly salary. And again, if you have any questions, just reach out to me.
Hey, Chris.
Go ahead, Chris.
Oh, Chris is muted.
Chris, you're muted.
Hey, my name's Chris Draves. I work out of the office in Easton, and I'm a technology analyst. And today I'll be talking about Mark Cuban's cost drug program. In January 2022, Mark Cuban, billionaire owner of the Dallas Mavericks and a medical genius by the name of Alexander Oshmanyansky, started Cost Plus Drugs, or more commonly known as Mark Cuban Cost Plus Drug Company, MCC PDC. It's headquartered in Texas. Cost Plus is focused on the pharmacy distribution of drugs with the goal to lower the prices for generic drugs by removing middlemen and by moving to a low-cost pricing strategy. Oshmanyansky asked Cuban to invest in a pharmacy he envisioned to manufacture generic drugs and skip the middlemen wholesalers. An intermediary layer of pharmacy benefit managers typically responsible for the heavy markup the drugs see between the manufacturers and the customers. Cost Plus trusted fulfillment partner is TruePill, whose nationwide pharmacy infrastructure ensures that the medication they provide is safe and delivered when promised. Cost Plus their goal is to greatly reduce the cost of drugs and to introduce transparency to the pricing of drugs so patients know they are getting a fair price. Cost Plus takes the cost of the medication and marks it up by 15%, so they continue to do what they do and invest in disrupting the pricing of as many drugs as they possibly can. Then they add the actual $3 cost their pharmacy partners charge Cost Plus to prepare and provide a client with their prescription. Mail order prescriptions pay a $5 shipping fee. This makes the sales price far lower than the pricing available in the marketplace. Cost Plus is in the process of constructing a 22,000 square foot factory in Texas for the purpose of manufacturing drugs in-house at the lowest possible prices. And as Mark Cuban says, everyone should have safe, affordable medicines with transparent prices.
Hello, everybody. My name is Jack Friedman. I'm an associate financial advisor with the Lexington office. And today I'm going to be talking a little bit about money market accounts, or MMAs, that you might have heard of. And an MMA, or a money market account, is an interest-bearing financial product that pays you for letting banks use your money. So in other words, you can buy into a money market account, and it is what I'm going into is there are a lot of different opportunities. So if you have an emergency fund or cash sitting on the sideline, it's a great opportunity to get actually right now it's a little over 4% on that money. So a couple good opportunities for money market accounts. It's highly liquid. So one idea is that you could have a money market in any normal account, but what I've thought of recently is an FSA or an HSA. If you go to make a purchase, it's fully liquid. It's a cash equivalent. So that means you don't have to make any sales in that account to be able to buy things through that FSA or HSA. So that's a good option. Lower risk. So there was actually, since the 70s, since the money market account was created, there was only one bank that broke the buck and what breaking the buck means is that then total asset value of the money market account goes below 1. But in other words, they weren't able to pay out at a level that was appropriate. That's only happened one time. So there's really, it's not quite FDIC insured, but it is, so it's on the lower risk. It's also high yielding. Right now you can see nearly 4.3%. Just keep an eye out if there are some low cost fees in these accounts. But if you have seen all over the internet probably now, there are a lot of different companies offering high yielding savings accounts, which can have higher fees than maybe these money market accounts can. So keep an eye out for that. Like I had mentioned, it's a great cash equivalent. You can write checks against the balance, and it makes it very convenient. And so there's, if you have any cash, like I mentioned on the side, throw it into a money market account. It's a good opportunity for the time being.
Hi, I'm Peter Deshane. I'm the technology manager here, and I work in the Eastern office. Today, I'm going to talk about mortgage rates. As most of us probably have heard from the media or elsewhere, mortgage rates spiked recently. Sort of close to above 7% or so. It have come down quite a bit though. So on the chart on the left here, we just have a quick chart of you'll see rate spiked, and then we're down as of a few days ago, down quite a bit. So as of yesterday, January 18th, the rate, these are kind of average rates surveyed from this mortgage company. 30-year fixed mortgage at around 6.04%, 15-year at 5.12%. Kind of notable here is that the 30-year jumbo mortgage is a bit lower than the 30-year conforming mortgage. The jumbo mortgages are those that sometimes need to be used to purchase a home which is over the FHFA limit, which actually has gone up this year. And so the national rate is $726,000. But that's higher for some of the more expensive locations, such as some of the counties here in eastern Massachusetts. One quick note is that the mortgage rates usually tend to follow the 10-year Treasury. However, recently, the difference between the mortgage rate and the 10-year Treasury has widened, meaning that someone who takes a mortgage will pay a bit more for a mortgage in relation to the 10-year Treasury rate than usual. So hopefully, as kind of some imbalances in the fixed income world kind of straighten themselves out, that spread will kind of go back to its usual average, and rates could go down a bit more if that were to happen. So I think the point is that if you find the right property at the right price, rates are actually at a reasonable place, just not as low as they have been the last couple of years. Thank you.
All right, hi, everyone. Yeah, can you make that bigger, Audrey? I'm Robin Uccioli. I am a certified financial planner and certified public accountant in the Easton office. And I'm going to talk about the Secure Act 2.0. As you can see, there's a lot of bullet points here. The act is a legislation that was signed at the end of 2022, basically as a follow-up to the Secure Act of 2019. And it was intended to make contributing to and then accessing retirement savings easier and more advantageous. It affects a wide range of individuals, from young people just beginning to contribute small amounts to retirement savings to individuals who have reached retirement age and are ready to access those savings. So one of the biggest changes that you've probably all heard about is an increase in the age that you are required to begin taking your minimum distributions from your IRAs. It has gone from, it'll be 73 years in 2023, and it will become 75 years in 2033. And it also decreases the penalty for failing to take the full required minimum distribution. In the past, that penalty was 50%, which was the highest and sternest penalty that the IRS had. Now it's fallen to 25% of any amount that you should have taken out but did not. And that drops to 10% if you withdraw the correct amount and amend your tax return in a timely manner, which is not quite defined yet. And then as of 2024, required minimum distributions won't be required to be taken from Roth IRAs that are in employer retirement plans. And also, as Bruce mentioned earlier, it increases the catch-up amounts. So basically, if you are 72 in or before 2022, you will need to continue your required minimum distributions as they were previously scheduled. If you turn 72 during 2023, you may want to reschedule the distributions that you had planned in mind. The latest you would be able to take your 2024 required minimum distribution, if it is your first time distribution, because you turned 72 during this current year, would be April 25th of 2025. I'm sorry, April 1st of 2025. But you would then have to take the 2025 years required minimum distribution by December 31st of 2025. So you can delay taking your required minimum distribution until April, but that would mean that you have to take 2 required minimum distributions in 2025. If you have a Roth IRA and an employer retirement plan, as I just mentioned, after 2023, you will not have to take any distributions from it. One change that is effective immediately in any plan annuity payment is that any plan annuity payments that exceed a participant's required minimum distribution can be counted as their required minimum distribution. So that's an advantage. Basically, if you're taking money out of here, you can now apply it towards your required minimum distribution over there. As Bruce mentioned, as of January 1st, 2025, people 60 to 63 years will be able to make catch-up contributions of up to $10,000. The 1,000 catch-up contribution for people 50 to 60 will be indexed for inflation beginning next year. Another big benefit that's been talked about a lot is that employers will be able to offer the option of making matching contributions, which it will be in after-tax dollars, into Roth IRAs for, excuse me. That's a new thing. And qualified charitable contributions are now allowed to be made into charitable remainder uni trusts, charitable remainder annuity trusts, and a charitable gift annuity. This is limited to $50,000 for a lifetime and that amount will be indexed for inflation. Another big boost is that as of 2025, small businesses that are trying to set up and implement savings plans for their employees, such as 401ks or 403bs, they will have to automatically enroll all eligible employees at a minimum contribution rate of 3%. So basically, a new employee once they become eligible in the plan, will automatically be enrolled at a contribution rate of at least 3%. But previously, the employee would have to make more efforts to enroll themselves once they were eligible. Then retirement plan providers will also be permitted to offer automatic portability to plan sponsors. In other words, if an employee has a small balance in their retirement account and they change jobs, it's going to be much easier for them to take that balance with them to the new employer with another retirement plan. Whereas previously, a lot of these small balance retirement savings accounts would have been cashed out, which is not advantageous for the employee or account holder. And then in 2024, Roth IRA accounts for non-highly compensated individuals will be able to be added to defined contribution plans as emergency savings accounts. So the contributions are limited to $2,500 annually. But if you need to withdraw from that $2,500 later in the year or future years, the first 4 withdrawals of a tax year are not taxed or penalized, which is a big benefit. And plan rules can even allow employers to match those contributions. In 2024, employees will be able to withdraw up to $1,000 a year for personal or family emergencies without incurring any penalty from any retirement account. Also, employers are going to be able to start matching employees' student loan payments with contributions to retirement accounts. So that's a bonus and an incentive for young employees to pay off their student loans, and it allows employers to help them build retirement savings. Another big change that is advantageous for the younger generation is that unused balances of 529 plans, if they are unused and still in the plan after 15 years, become eligible for rollover into Roth IRAs in the name of the beneficiary. So the rollovers are subject to the annual Roth contribution limits, and there is a lifetime limit of $35,000. So that means that if you are saving into a 529 for a child who does not use all of that 529 for their education, that can give them a nice start to retirement savings at a very young age. And then for small businesses, as of this year, the tax credit that they receive for the cost of starting up a new retirement plan increases from 50% to 100% of those costs. And a small business is one with less than 50 employees. That is an overview of the changes in the Secure Act 2.0.
Great. Thanks, Robin. Hey,
Jack alluded to it a little bit before, and fascinating thing that's happened. Perhaps a silver lining in the black cloud that was last year's investment environment
is that we now have interest available on investments. Jack mentioned money market. That's certainly something that's available now. But let me tell you a bit about how we got to this point and then what we have available. So last year, at the beginning of the year, the Federal Reserve told us that interest rates were going to go up in 2023, and they were going to go up from 0.25%, which is where they started at the beginning of the year, to 0.75% by the end of 2022. Well, that didn't happen. Not exactly, not even close. Interest rates went up from 0.25% to 4.5%. That's the fastest move. And you know, interest is not just a numerical value, but it really translates to how much does it cost to rent money for a year. Okay, that's essentially what it is. You want to borrow the money, you pay some rent on that money, and you hold it for a year. If you're a business, at the beginning of the year, it cost you 0.25%. By the end of the year, that was 18 times the cost of borrowing money. So your outstanding debt, if you were a business and you were in a variable rate borrowing scenario, you know, you have $10 million borrowed, and your interest payment on that money went up by about 18-fold. It was an enormous change and way different from what the Federal Reserve told us. So with that all being said, we expect from what the Federal Reserve has told us this year, and they are so accurate every year, that interest rates will go up by 0.5 to 1 full percentage points from here and then stop moving up or down. What does that mean? Well, right now we can get high quality corporate bonds yielding about 5.5% or so, a little less than 5.5%. With this increase in interest rates that we're going to expect to have happen in this first half of the year, you know, that might be as high as 6.5%. And you know, that's pretty interesting because at the same time, the action of the Federal Reserve is driving down inflation. And so if inflation does get back to the 2% target and you lock in 6% in your bond interest rate, that's a pretty good spot to be in. That might even be more interesting than stocks. High quality municipal bonds right now, so that's tax-free interest, are about 3.5%. Now, the thing with the tax-free municipal bonds is they're all priced by the people who are in the highest tax bracket because they're willing to pay the most for those bonds because they get the biggest benefit from the tax deferral, the tax-free nature of the income. So if you're not in the highest, municipal bonds might not make the most sense. But if you are, muni bonds, high quality, 3.5% right now, perhaps 1 percentage point higher sometime before the end of the year. Now, if we're going to look at high yield, take on a little bit of risk with our bonds, we could get like 9% right now in high yield bonds, and we can get about 5.5% in high yield municipal bonds. Yeah, that's pretty darn good. As Jack would said before, money market, 4.25 right now. Again, percentage point higher perhaps before the end of the year. You know, an investment in money market that is very stable, as Jack had said, $1 a share. If interest rates go higher, you just get more interest. Doesn't really affect the value of the principal. And we've talked to a lot of people about floating rate bonds. Now, the nice thing about floating rate is as interest rates go up, the interest being paid goes up. But the reverse is also true. We will eventually see interest rates go down. The market expects interest rates to decline. The Federal Reserve has said interest rates won't decline. It's going to be interesting to see who's right there. But floating rate today pays somewhere between 7 and 11%. And then we expect that'll go up, and perhaps if the market's right, go down a bit. If the Federal Reserve is right, go up and stay at, you know, in the 8 to 11 or 12% range. So bonds, which is something we really haven't emphasized for the last about 15 years, really since 2009, we really haven't talked much about bonds. Bonds are really starting to look a whole lot more interesting. That's all I've got for this slide.
All right, thank you, Andy. My name is Patrick Hanlon. I am a certified financial planner and associate advisor with Bickling Financial Services. I work out of the Lexington office mostly, but also, as you see today, I'm in the Linfield office. I'm going to talk a little bit about home equity and using that home equity. So over the last couple of years, the last few months, we've definitely seen a slowdown, but you're a homeowner, you've started to see a lot of equity build up in your home. The average, the national average during just the year of 2021 was that you accumulated $55,000 of equity in your home during that year. So there are advantages to getting that equity, and there are ways for you to tap in and access some of that equity. Options available we have listed here. One would be the home equity line of credit. You're probably called like a HELOC loan. That's having access to line of credit. You don't take out a specific amount. You might say, and usually there's a cap depending on how much equity you have in the home. Usually that's capped at like 75 or 80%. But what you're able to take out, and you can say, I want a line of credit similar to what you might have with a credit card. You're not going to use all that money at a given time, but you would have access to take that money at a given time. And there is usually an adjustable rate attached to that. So as we've talked about, interest rates going up or going down, the interest rate that you're going to pay back, and that's how you would pay is the interest only is what you need to pay with access to it. You would only need to pay that interest back, and the rate could change depending on rate changes. The other options would be a home equity loan. That would be similar to, say, like a second mortgage, where you take out, again, a loan on the equity for your home. Those could be adjustable rate or fixed. And the last option would be the cash out mortgage refinance. Now, that's the one that a lot of folks used kind of post 2020, where rates were really low. They gained equity in their homes. They were able to tap into that equity and get that full lump sum. We would probably say that those aren't the best options now, based off of what Peter had mentioned, of where mortgage rates are and where they've been, and kind of what Andy talked about too. The HELOC line of credit is probably going to be a better option for you. There is some tax deductibility to consider as well. As long as you're using the funds for home improvements, those can be tax deductible, and that's for the amount up for loans up to $750,000. There's some more details there too, but those are the basic options for you. And it's a way, to where we've talked about, it's been a turbulent time in the markets over the last 12 months for sure. This is a way that you can access some cash. Don't have to sell an asset that may be down 10 or 15% at the moment. Wait on that to, if it has good growth potential, come back. You can tap into some of the equity this way. Thanks.
Great, thanks. I get started now. Thanks, everyone. So my talk is about the new tax credit for electric vehicle. So one of the things that happened last year is there's a big tax credit, a big push for electric vehicles, especially electric vehicles made here in the United States. And so if you are able to take advantage of it for a new car, married, filing joint, if you make under 300,000, you're eligible to get the tax credit for it. The car has to be under $80,000 in price sticker for larger cars, and then the tax credit is between $2,500 and $7,500 depending on the size of the battery. The interesting thing is now this is also true for used cars. There is a ability to buy a used electric vehicle and get a similar credit. It's about you have to have lower income, but if you do have lower income and you do qualify for it, you can get an electric vehicle. The list of electric vehicles is a lot larger than it's been in the past. Obviously, there's been a big push in the industry to offer more electric vehicles. And so if you are in the marketplace for an electric vehicle, it's very easy to do a search on which electric vehicles are qualifying for the credit. And again, it can be a pretty significant amount of money when we're talking about $7,500 of credit that goes right off the top of the cost of that car. So if you're interested in looking at a new car for this year and electric vehicles are on your list, it would behoove you to take a look at the list of electric cars that qualify for the credit to see if it's something that you might like.
Awesome.
Hi, I'm Meg Graziani, and I the operations manager here, and I work in Lexington, in the Lexington office. So as cyber fraud incidents are on the rise, Fidelity has implemented additional measures of security to further authenticate our clients. So beginning this year, January 1st, 2023, new accounts that are opened without mobile and email addresses will be restricted from opening new positions. So for clients who are opening additional accounts, also please be sure to let us know of any email or cell phone changes. That's what I have to say. Thanks.
All right, so you get me again. Andy Betts again here. 529 plans. Rules have changed a bit over the years. You know, when we started talking with people about 529 plans, something around 15, 20 years ago, we would always tell parents to consider trying to build up a 529 plan balance that would cover about half the cost of college. And why would we say half? We'd say half because getting money out of a 529 plan, if it wasn't to be used for college, would result in some penalties and tax. So at least under the older rules, if you wanted to, if you ended up with a leftover balance, and you wanted to take that out, you could take out your basis, the amount that you put in, of course, but then all of the gains would be subject to a 10% penalty plus ordinary income tax. So think about that in Massachusetts, right? So let's just say you're in the 35% tax bracket, because that makes the math pretty easy. You're in the 35% tax bracket federally, plus 5 state. That's 40 right there, and then another 10 for the penalty. That's half. So you're giving up half of the remaining gains. And unfortunately, you're not allowed to take out your basis first. You have to take it out as a ratio. So if essentially the account tripled in value, 1/3 of it, every time you take $1 out, 1/3 of that would be basis and 2/3 of it would be gains. So you'd always then be left with at least 2/3 in gains that you would pay 50% in total tax on. Of course, if my math was right with your tax rate. So there have been several changes over the years, and most recently in the Secure Act 2.0, as Robin mentioned, there's another way out. So here's one of the ways out. If you build up a very large 529 plan balance, and let's just say that's built up by a grandparent for a newborn, or you could even start a 529 plan for a child that doesn't yet exist. You say, hey, my daughter just got married. I'm going to set up a 529 plan for the child that she may have at some point in the future. No pressure, but I'm going to put this plan together for you, and I'm going to fund it with, I don't know, $50,000, $60,000, which you absolutely can do. Well, if that child ends up going to private school, the balance grows significantly. Maybe you want to use some of that money for private school. You could use $10,000 a year. Used to be just high school, now it's K-12. So you've got a long time to be able to pull out chunks to be used to offset the cost of private schools. If your child, they figured this out along the way, if your child gets a scholarship, that was the other objection that some people had to 529 plans. What if my kid gets a scholarship and then I have all this money left in the 529 plan that I have to pay all these taxes on? Well, the government allows you to take out of the 529 plan, tax and penalty free, the value of the scholarship. That could be a, athletic scholarship, academic scholarship. It could be that the employer that your child works for pays for some of their education. Some kids do go to work and they get tuition remission or various other things. you can take out of the 529 plan. That you can also take out any kind of military or veterans benefits or the cost of a service academy. All of that can come out of the 529 plan tax-free, you just get it back. There are these other things called the American Opportunity Tax Credit, Lifetime Learning Tax Credit. There's a way that you get a certain amount of those things can be pulled out of the 529 plan tax-free. That could be a few more $1,000s a year. After the child goes to college, completes, and then has a student loan obligation, now you can take out an additional $10,000 to pay down student loans. Can be done all at once or over time, but $10,000, and obviously the government has been kind of messing with the student loan repayment plans. We don't know where that's going to end up because it's in court, but $10,000 can come out of a 529 plan. The 529 plan doesn't have to only be used for undergraduate school, could be used for graduate school, professional training, a career change later on in life. So maybe it's good to leave some balance in there. Robin mentioned now it looks like we're going to be able to put $35,000 into the beneficiary. Unfortunately, not the owner of the plan. It's not your money. It's going to be your child or grandchild's money, but it could go into their Roth account. They have to be eligible to contribute to Roth, and they can only put in the amount of money that they're eligible to put into a Roth. So it's not additive to what they might want to put in themselves, but that money can come out of the 529 plan, go into a Roth IRA. You can also, at the if there's a residual balance, you can change the beneficiary. So you can change that beneficiary to be a sibling. So you can have multiple accounts, or some families have only one account for lots of kids. But you could transfer that to a sibling who might be going to a graduate program or something along those lines. You could transfer it down a generation, which is really kind of interesting. You can transfer, if your child goes through school and then has a residual balance left, even after the 35,000 comes out for Roth IRA, they still have $5,000, $10,000, $15,000 in there. Leave it alone. It could be for their kids, which is a really nice feature. Or you could name any other beneficiary. We haven't yet seen if the $35,000, the way the rule was written, is that it's for the beneficiary. It doesn't yet say if you could do a $35,000 rollout to one beneficiary, change the beneficiary, and do another $35,000 to the next beneficiary. But I'm sure that'll be clarified soon. So to sum this up, we used to say no more than half. Now we're saying you can go ahead and fully fund or even overfund, because that money could be passed down to the next generation or be used for retirement for the beneficiary. Thanks.
One of the things we were hoping to be able to tell you about is a little bit more about beneficial IRAs, but unfortunately the IRS hasn't finalized it. We thought that Secure Act 2 was going to do it, but right now, after 2019, so starting in 2020, if you had an inherited IRA, we know that they have to be liquidated within 10 years. We just don't know the rules between years 1 and years 9. We don't know if you have to take out money or you don't have to take out money. The IRS has not clarified that yet. They have clarified that until they figure out that rule, they're not going to punish anybody for not taking money out. We assume at some point this year, when they clarify the rules, they are going to require people who have a beneficial IRA, even if it's after 2020, that you're going to have to take out some money. Well, we've heard different figures, anywhere from 10% to lifetime income. So we don't know what it's going to be yet. I know some people have some questions about it. So do we. There's more to come on that. Hopefully we'll know by the end of the first quarter. And then we'll give people an update on that once we've gotten that finalized.
Great. Question.
And so just to do a quick summary, so I think some of the big action items, because we wanted to make this like what you should be doing. If you're still active in an employee, and you want to max out your 401k, make sure that you make the adjustments because those amounts have been increased quite a bit. If you have money sitting on the sidelines and you are wanting to get a little better interest, make sure you look at money markets and see what rates are available to you at your bank. If you are on prescription drugs, there are, the Mark Cuban one is one of the bigger ones out there. There are probably other ones. So I think it's do some research. We just thought that was a great model and helps out people because, again, we know prescription drugs can be a large cost in retirement. If you're looking to buy a house or one of your kids are looking to buy a house, again, mortgage rates are coming down. We do think they have further to fall, but they are coming down, so they're not quite as bad as what the media might let you think about because they haven't updated their numbers as far as where mortgage rates are. If you're in the market for an electric vehicle, make sure that you understand the tax credits around there. And again, if you're opening up an account with us at some point and we say, hey, we need your cell phone number, just understand that's a security issue and we're going there. And I think Andy did a great job about talking about 529 plans and why we think there's some new advantages to putting money in there if you have anybody that might need to be using educational money. I know that we talked very quickly. We had a lot of ideas we wanted to share with everybody. We hope that you either scribble down some notes or this led you to want to have a deeper conversation with one of us about a topic that that we reviewed. So if you do, please feel free to reach out to us. We will open it up to questions if anybody wants to put them in the chat. We thought this was going to take an hour and it pretty much did. So if there's no questions, we'll let everybody go. But if you have any questions, feel free to throw it in the chat or unmute yourself and you can go ahead and ask it. All right, I want to thank everybody again. If there's something that you want to follow up with us, please let us know. Thank you for your time and always thank you for your business. Bye-bye.
Thanks, everybody.